first, let me thank my dear sister, Kristina Georgieva, the Managing Director of the International Monetary Fund, for joining us here. I know it's early for you. It is such a great honor to have you, my sister. I think you are the first IMF Managing Director to ever attend an annual meeting of the African Development Bank. It goes to demonstrate the close cooperation between the African Development Bank and the IMF. Now, you are doing such a great job at IMF in these challenging times for the global economy. Your leadership will continue to be crucial. I am equally delighted that we are joined by the newly minted, well, some months ago, Director General of the World Trade Organization, my dear big sister, Ngozi Okonjo-Iweala. Let me also say that this is also a first for a Director General of the WTO to attend the annual meetings of the African Development Bank. Well, the women are breaking records. Thank you very much, Professor Leonce Ndihokubwayo, for making the time to join us. We look forward to hearing your insights. Now, I have been asked to make a few remarks on making that work for Africa. Africa faced its worst economic recession in over 50 years due to the COVID-19 pandemic. As a result, Africa's GDP declined by 2.1% in 2021. While growth is projected to recover to 3.4% by this year and also next year, better, the deep scars of the pandemic are really there and will take time to heal. Africa's cumulative GDP declined by $145 billion to $190 billion. Poverty and inequality have worsened. 30 million people fell into extreme poverty in 2020, and an additional 39 million could fall into poverty by the end of 2021. Now, let's look at the debt numbers. Debt to GDP ratios are projected to increase by 10 to 15 percentage points, rising from 60% in 2020 to 75% by 2021. The debt situation is pervasive. As of March 2021, 17 out of 38 African countries for which debt sustainability analysis were available, they were in debt distress. 12 countries were in moderate risk of debt distress, while 6 are already in debt distress. Only 1 country had low risk of debt distress. The structure of debt composition has shifted significantly over time, away from traditional sources, such as multilateral and Paris Club lenders, towards private creditors and non-Paris Club members. In 2000, bilateral creditors, mainly Paris Club members, accounted for 57% of Africa's debt, which has since declined to 27% by 2019. Now, on the other side, share of debt owed to private creditors has more than doubled, rising from 17% in 2000 to 40% in 2019. Africa's total outstanding debt of $841.9 billion at the end of 2019 more than doubles the size of the continent's annual government revenues of $501 billion. It is clear that if there is no debt relief and restructuring, many more countries will slide into debt distress. The African Development Bank estimates that Africa will need additional gross financing of about $485 billion between 2021 and 2023. The challenge is how to find the resources and reduce the debt levels. And let me say, we must learn from past experiences. Debt restructuring and resolution should be concluded much faster. We must avoid Africa experiencing another lost decade, as it happened from previous debt restructuring, which took 8 to 10 years to resolve, leaving lingering scars and consequences. Progress is currently being made slowly. The Debt Service Suspension Initiative, DSSI, has helped to provide temporary debt service relief for 31 out of 38 eligible African countries for a total of $4.5 billion. But the DSSI does not reduce the quantum of debt. Neither does it reduce the bullet payments due once the moratorium ends. The G20 Common Framework for Debt Treatment, which seeks to provide common treatment for private creditors and, of course, bilateral creditors, while a progress beyond the DSSI has not seen much success. Only 3 African countries, Chad, Zambia, and Ethiopia, have signed up. With the immediate actions of credit rating agencies to downgrade Ethiopia, it is unlikely that other countries will participate. The $650 billion of special drawing rights to be issued by the IMF now offers the most significant avenue to boldly address the debt challenge. As U.S. Treasury Secretary Janet Yellen said, the smartest thing we can do is act big. The agreement of the G7 leaders to back efforts for reallocating $100 billion to African countries is acting big. It will be a game changer. The issue is how these SDRs are used. We should have flexibility. In addition to the use of SDRs through the Poverty Reduction and Growth Trust, PRGT of the IMF, additional complementary options should be considered. As agreed by African heads of state and global leaders at the Summit on Financing African Economies, some of the SDRs should be provided to the African Development Bank to unlend to public development banks to support green recovery, build climate resilience, and assure inclusive recovery process, including support for vaccines. As a prescribed holder of SDR, the African Development Bank, as a AAA rated institution, can leverage the allocated SDRs several times to deliver larger volumes of support to African countries through sovereign and non-sovereign operations. It is also time to establish an African financial stability mechanism to help African economies to protect themselves from exogenous shocks. Africa is the only region of the world without such protection. The African Financial Stability Mechanism will help to mutualize Africa's funds and avoid spillover effects that come from pandemics or any other shocks. It will also allow African countries to agree on a set of convergent macroeconomic policies and principles and pool funds necessary to address debt vulnerabilities in Africa. It will also act as a regional safety net to complement the global safety net of the IMF. In closing, let me offer 5 thoughts on making debt work better, I must say, for Africa. First, there should be full transparency on debt, especially those owed by state-owned enterprises to non-Paris Club members. In particular, resource-backed loans to bilateral and commercial creditors. Second, we must strengthen the nexus between debt, growth, and governance. Unless there is good economic governance, debt relief may not lead to growth. Third, countries should also use debt well, focusing on using debt to finance productive social and economic infrastructure. Fourth, stronger institutional capacity should be built to improve the efficiency. Fifth, greater attention should be given to domestic resource mobilization, tackling corruption, building strong institutions for public expenditure and financial accountability, and debt management. Now, I know that all our panelists and all of our governors will have lots to share with us as we ponder on these questions. I look forward to hearing your thoughts. Thank you very much.
So how can we boost debt productivity in Africa? I now turn to the World Trade Organization's Director General, Dr. Ngozi Okonjo-Iweala, for her answers and recommendations.
Debt levels were rising, but economic fundamentals were generally getting stronger, with rising investment and export orientation. Instead, as we know, Africa endured its first recession in 25 years as COVID-19 battered the world economy. After contracting by 1.9% last year, sub-Saharan Africa's economy is set to grow this year by 3.4%, according to the IMF, slower than other regions and well below the 6% global average. Africa embodies the two-track K-shaped recovery we increasingly see in the global economy. Advanced economies, China and a few others, are surging ahead, with other countries lagging behind. This K-shaped recovery is visible in the trade data as well. By 2022, African imports are said to be only 0.1% higher than in 2019. But import and export growth over the same 3-year period are said to be significantly stronger in Europe and North America, and several times higher for Asia, where imports are set to rise by 9% and exports by 12.5%. There are two main reasons African countries are being left behind in this crisis. The first is vaccine inequity. Africa has received 3.2 COVID-19 vaccine doses per 100 people, compared to 75 doses per 100 for people in developed countries. Beyond the intolerable implications for the health and well-being of individuals and families, low vaccination rates mean that economic life cannot fully resume, and African countries risk exclusion from global travel and related trade. The second is the lack of fiscal space and borrowing capacity to deploy in service of providing household and businesses economic relief and stimulus. Advanced economies have deployed fiscal and monetary support equivalent to about 25% of GDP since the beginning of 2020, according to the IMF. In low-income countries, the equivalent figure is under 3% of a much lower GDP. A new SDR allocation will allow poor countries to access short-term liquidity and will be amplified by reallocations and on-lending from advanced economies. As in previous crises, a familiar problem, the lack of diversification of our economies on the continent, made it harder to absorb and spread shocks across the spectrum of the economy. Debt to GDP ratios have increased in countries around the world, driven by the growth slowdown and the need to spend money on COVID-19 relief and response. But many African countries are particularly vulnerable to debt traps and serious fiscal sustainability problems. Even before the pandemic, debt levels had been rising, helped along by low borrowing costs. Already in 2019, several African countries had debt ratios of 100%, with many countries reaching levels not seen since the HIPC restructurings 15 to 20 years ago. Debt servicing costs had also become more burdensome. Debt service to revenue ratios were close to 19% in Ethiopia and Mozambique and 27% in Kenya. This meant fewer resources for productivity-enhancing investments in people and infrastructure. Even where debt to GDP or debt service to export ratios are not very high, tighter access to dollar financing because of the COVID-19 crisis means we're already seeing cases where scarce foreign exchange is going to fund debt repayment instead of capital investment. The World Bank IMF Debt Sustainability Framework assesses whether low-income countries have weak, strong, or medium debt carrying capacity, depending on their macroeconomic performance and policies. Higher debt carrying capacity means higher thresholds for debt distress. According to this framework in 2019, of the 37 low-income countries in Africa, only 7 had debt carrying capacity that could be characterized as strong. 17 were medium and 13 were weak. All 13 of the countries in the weak categories had public debt to GDP ratios exceeding their recommended threshold of 35%, often by a large margin. Of the 17 countries with medium debt carrying capacity, 7 had debt to GDP ratios close to or greater than the risk threshold of 55%. But only 3 exceeded it by a significant amount: Sao Tome and Principe, Ghana, and the Gambia. 6 of the 7 countries with strong debt carrying capacity had debt to GDP ratios below the 70% level considered safe. The pandemic has worsened debt burdens, particularly for the countries most vulnerable to debt distress. According to IMF estimates, countries with weak debt carrying capacity saw their average debt to GDP ratios increase by nearly 10 percentage points. Countries with medium carrying capacity saw their average ratio rise by about 4 percentage points, while those with strong carrying capacity jumped around 6 percentage points. In a paper this past spring, the IMF and World Bank warned that 54% of either countries were in or at high risk of debt distress, some facing interest burdens higher than pre-HIPC levels. Middle-income African countries have also seen their debt burdens increase sharply. Amid falling prices and reduced demand for oil worldwide, Nigeria's debt to GDP ratio rose from 29 to 35%, Algeria's from 46 to 53, and Egypt's from 84 to 90%, Angola from 107 to 127%. Debt to GDP ratios also increased for non-oil exporters, including South Africa from 62 to 77%, Morocco from 65 to 76%, to name just a couple. For many countries, external debt service burdens threaten to impede their ability to support economic recovery and future growth. Debt restructuring and reprofiling are firmly back on the agenda. We know from experience that acting promptly and decisively is more effective for debtors and creditors alike. As I told a high-level UN event on the international debt architecture a few months ago, lost decades are a policy choice. The G20 Debt Service Suspension Initiative, DSSI, which allows low and lower middle-income countries to suspend payments to bilateral official creditors, has been extended through the rest of 2021. A longer extension would free up more revenue for the 32 African countries currently participating. The Common Framework for Debt Treatments, which has been endorsed by the Paris Club, opens the door to reprofiling and restructuring for countries when necessary. The involvement of private sector creditors is critical. While official debt remains predominant, the share of commercial debt went from 5 to 20% of the external debt of DSSI-eligible countries between 2010 and 2019. Chad, Ethiopia, and Zambia have requested debt treatment under the common framework. It may be time to revisit Kruger's idea of a sovereign debt restructuring mechanism, since the growing diversity of creditors incentivizes holdouts. Looking to the future, while the pandemic was certainly not the fault of African policymakers, it is clear that macroeconomic management needs to build in shock absorbers. This is where the ratios recommended by the IMF for debt to GDP or debt service to revenue can be useful. It's tempting to ignore such threshold when times are good, but they can help countries minimize disruptions when crises arise. We also need to manage our public finances much better. This means better governance. It means more transparency, the use of technology platforms for revenue management so as to minimize leakage. It means serious efforts to tackle corruption. And it means raising revenue domestically, including by closing corporate tax loopholes for multinationals. There have been promising steps forward on international tax cooperation in the OECD G20 process. The recent G7 agreement is significant because it would put a floor under tax competition. That said, many developing countries, including the African Tax Administration Forum, have concerns that the G7 proposals are necessarily complex and favor countries where multinationals tend to be headquartered. When thinking about how to use debt productively, it is paramount to think about how it is managed and what it is used for. Debt needs to go into high-yielding activities with high rates of return. As Director General of the WTO, you would not be surprised if I point to a link with trade. One potential area for high returns on investment is acting to lower what economists call trade costs, the costs associated with moving goods from the factory gate to the final consumer. This would raise the productive capacity of African economies, ultimately reducing real debt burdens, while helping build regional value chains and increasing the global competitiveness of firms on the continent. Currently, moving manufactured goods across international borders costs roughly 2.7 times more than moving the same goods across the same distance domestically. Costs are even higher for agricultural goods and services. Shipping and logistic expenses often account for a significant share of these costs and are a key factor in why trade costs between high-income countries are much lower than those among low-income economies. Managing trade costs in the context of open border initiatives like the African Continental Free Trade Area could be potentially transformative for the continent. Infrastructure and regulatory reforms that lower domestic and international trade costs could further generate sizable rates of return for both domestic firms and households. This would involve investments in hard infrastructure like ports, roads, and border posts, but also soft infrastructure like digitizing trade processes and improving the internet infrastructure underpinning e-commerce. There is also a strong case for innovation in debt management. New vehicles can bring lower cost development and trade financing without introducing systemic risks. One such idea is the UN Economic Commission for Africa's Liquidity and Sustainability Facility, LSF. It has proposed a partnership with major asset managers and multilateral development banks to try to lower government's borrowing costs by essentially creating a repurchase or repo market for holders of their sovereign bonds, akin to those that exist in advanced economies. Holders of sovereign bonds will be able to post them as collateral for low-interest loans. One possible avenue to seed capital for the Liquidity and Sustainability Facility could be through on-lending of some of the new 650 billion SDRs equivalent to be created by the IMF. By increasing demand for sovereign bonds, government's borrowing costs will be lowered and fiscal space expanded. In conclusion, I want to point to one thing pandemics and debt crises have in common. Prevention is better and cheaper than crisis management. But on both fronts, we tend to underinvest in preparedness. Debt management strategies in Africa need to build in the potential for external shocks and adverse events that constrain fiscal space and result in negative debt-related spillovers. But at the end of the day, we can't keep going through cycles of indebtedness, crisis, restructuring, and recovery. This is bad for long-term growth and living standards. We need to build in a sustainable way ahead. George Santayana's famous aphorism is particularly true when it comes to sovereign debt. Quote, "Those who cannot remember the past are condemned to repeat it," unquote. Thank you, ladies and gentlemen.
And we would like to thank you very, very much, Dr. Okonjo-Iweala. You have brilliantly set the tone for our first panel of the day. Indeed, like President Adesina mentioned in his opening remarks, progress is being made, but more still needs to be done. And this is precisely why we are all here. Our continent, beautiful Africa, deserves our joint effort. So, ladies and gentlemen, for the next half hour, we'll explore in further detail the link between debt, governance, and growth, how to strengthen it, which public reforms and actions are needed to boost debt productivity. These are a few of the questions we'll address with our esteemed panelists, whom I now have the pleasure to introduce. And ladies first, Madame Niale Kaba, ministre du Plan et du Développement de la Côte d'Ivoire et présidente du Conseil des gouverneurs de la Banque
Planning and Development of the African Development Bank, of the Government of the
Ministry of Finance of Zambia and African Development Bank Temporal Governor for Zambia. Tarek Amer, Governor of the Central Bank of Egypt and African Development Bank Governor for Egypt. And last but not least, Alamine Ousmane, Minister of Economy, Planning and Regional Development of Cameroon and African Development Bank Governor for Cameroon. Chères Madame, chers Messieurs, soyez les bienvenus.
Ladies and gentlemen, welcome.
The key policy concerns of our continent, debt sustainability and growth. And we truly want to draw from your expertise today. We want this discussion indeed to be a discussion, and we really want it to be action-oriented. I have two main questions for you. I will ask it and then go to you in turn to hear your remarks and recommendations. So A, what do you believe are the priorities in terms of governance reforms for African countries in order to manage their public debt productively and transparently? B, how could we increase the level of low-cost, low-risk development financing available to RMCs, those are regional member countries? And I would like to go straight to Zambia, a country which I'd love to discover, to have your opinion first, please, Mr. Chikuba.
Thank you so much, and thanks to the bank president for the opportunity. I think this topic is a very important topic, and it comes at the backdrop of our citizens being impatient for development, pressure on us policymakers to deliver the development, but also a shrinking space in terms of affordable financing. And hence, most of our countries went into debt, and then debt's really taking advantage of market access into unconcessional debts. Now, when it comes to reforms, of course, we found ourselves in what we view as a second debt crisis as a continent. And for me, the issues around governance, I would separate them into two. The first one is the legal aspect of it. I'm mentioning some reforms that we need to carry out in terms of our legal architecture to bring in more transparency for our citizens and the international community on debt borrowing. And the second aspect, introduce oversight institutions that will ensure that there is alignment in terms of debt. The second level is institutional, and under institutional, I'll put it into two. The first one is a fiduciary role. How do we ensure that going forward, debt is aligned to national plans, debt is aligned to project appraisals, and in that way, then there's control. And under institution as well, how do we deal with the issue of revenue collection? And in here, I'm talking about issues about revenue leakages and the like that come into play just to be able to cover that space. So I would look at it in terms of legal and institutional reforms, trying to deliver on that transparency as a start. Thank you.
We are not getting the moderator. I don't know if it's the same situation for you.
Thank you. Thank you very much for mentioning that. So I'll just go back to you, Minister Chikuba. You have mentioned leakages, and I know this is such an important issue when we talk about debt management and making it work for Africa. So I would actually like to ask you, what recommendations do you have there? Which instruments could we use to stop those leakages?
I'll take it that the ceiling of these leakages is really at two levels. One is the domestic level, and the issue of increasing tax compliance, introducing electronic means, and I should say that for electronic means, COVID has actually been a blessing in this regard, because most of our countries have made strides in this area. But the second aspect of it is to try and deal with international tax treaties, trying to deal with multinationals and the aspects of transfer pricing. I think it's a real one, especially for resource-based countries such as ours. And so those issues, I think we need to look at them and get expertise at an international level and through the bank largely to try and address some of these leakages. So there are domestic measures that we need to deal with, but also international.
Mm-hmm. Thank you very much. I would like to go to you now, Minister Amer. What is your take on these issues and bringing in your expertise from North Africa?
Mr. Chairman, Mr. President, dear governors and distinguished participants, I will speak a little bit more spontaneous, not out of something that is written, because I want to speak from my convictions and from my experience in Egypt over a number of crises that we have seen before. And I think the subject is huge because it's related to everything in the economy. So in order to try to focus it in 3 minutes, my views in terms of debt, I think our concern is really restabilizing our economies. And we have not to lose focus about our economic objectives. My personal belief is that any government should have two main economic objectives, which is creating jobs and the price stability, avoiding inflation so that purchasing power of consumers, of citizens is not eroded. And in order to achieve this, the question is how. I mean, a lot of experts, they speak around, but how do we do it? And how we do it, I think it depends on 3 matters. How we manage our fiscal policy, how we manage our monetary policy, because the balance of payments is very important, because a balance of payments, a healthy balance of payments spills over into everything into the economy. And the third thing that the policymakers have to observe the wellness and of the markets. The policymakers have to understand and not lose sight about how the market is doing. So we cannot be on the fiscal side trying to rebalance debt and budgets, and the market is suffering and is paying higher costs that is depriving the market from growth. So fiscal policy can be trying to improve our finances on the expense of the private sector and industry and trade and etc. So we cannot kill the chicken that's giving us the golden eggs. So we have to have longer views in terms of managing those fiscal situations. Usually governments, because of the short nature of their presiding in jobs, they try to look for quick results, but this is very damaging on the long run. So they should be responsible for the healthy market. So if any sector in the market, whether agriculture or contracting and construction or fertilizers or textiles or whatever, or food product is suffering, it is the responsibility of the finance managers, the finance ministers. They are not just responsible to gather their figure properly and the market is dying, because the market is going to give us the returns. And if you noticed during the COVID crisis at the beginning, central banks of major countries, they said we are migrating from targets. There are no targets. Our objective now is to save the economy, to save the corporates, the small players, the medium-sized players, the consumers. And we are going to sacrifice for that. So they didn't say we are going to make sure that our budget targets are achieved. So the concept and the approach to managing our debt has to take all this into account. It is not about today, it's about tomorrow.
You've mentioned the fact, sorry to interrupt you there, Minister Amer. I was going to say, no, not at all.
Can I finish, because my thoughts will, okay?
Absolutely.
In order to achieve that, it's not easy, because the monetary policy, the foreign exchange policy, the interest rate policy, and the fiscal policy, they have to be independent. And this is a very big word. And many times in our meetings together, and in the presence of the representative of the African Union, I told them that we request from the African leaders to give independence to the central banks and fiscal policies so we can see the results that we want. We have experienced this in Egypt, and we have seen very good results. So this is an important matter that on the other side, the government is also responsible to create growth so that the debt, it can help the debt go down. But growth in the private sector needs good policies in pricing energy, utilities, agriculture, and so on and so forth. So, and this calls for structural reforms, and the structural reforms is a big challenge, and it needs a very serious government and very high support and empowerment at the top, because at the end of the day, we want to give flexibility to the fiscal in terms of financing itself. We need to get the fiscal to be able to access the global markets, the huge trillions of dollars. And they cannot approach this except if they have meaningful and sound fiscal and monetary policies that will give confidence to international investors. This, of course, improving balance of payments, improving flow of foreign exchange, improving the level of inflation and prices. And so it is an ecosystem that needs to be tackled. But as I said, the focus is very clear, is that we need to look at employment and inflation and start putting the policies at the government side and at the central banks to be able to achieve the destabilization, because at the end of the day, this is the demand of our communities. I want a job, or my personal income is being eroded. Thank you very much.
Thank you. We'd like to thank you. I just was going to say there that it was very pertinent of you to bring it back right down to the population. It is about, how can I afford a living, about the jobs. So thank you very, very much.
Thank you.
I would like now to turn to you, Mr. May. Quels sont, selon vous, donc, quand on
In your view, when we talk about priorities in terms of reforms and governance, enabling our African countries to better manage debt, what would be, in your view, these priorities to ensure that this transition is more productive and transparent? I would be very interested in hearing your views.
Before I come back to you, let me start by thanking our chair for the Board of Governors and the president of our bank for giving this opportunity to share. I want to say my best greetings also to my fellow governors. Having said that, vous venez de poser une question importante.
You just raised a very important question, which enables me to share my opinion. That is to say that the recurrent concern is that we do not see enough of a correlation between debt and growth. And this is why all of the various players who follow development in our countries wonder about the impact of debt. You said this very clearly. We need to enact reforms, and reforms not only in the area of debt. There are at least 4 areas that need to be tackled together in order to ensure sustainable growth, to keep up or keep abreast with the debt aspect. First aspect has to do with revenue. If we do not diversify enough and improve domestic resource mobilization, we will not address the upstream issue of debt. It is therefore crucially important to mobilize more resources and to leverage digital technologies to facilitate collection as well as to expand tax bases. So in terms of public expenditure, this is an area that also needs to gain greatly in effectiveness and in quality. If quality and effectiveness are ensured, this will lead eventually to lower debt and better debt management. Now, to focus on debt, since we need important resources to grow, especially to invest in infrastructure, we find that the quality of the process leading to use of these resources, debt-based resources, are not necessarily what we wish for. My colleague just mentioned the regulatory and legal measures, but beyond that, we also need to think of discipline in implementation of our projects that draw on debt as a resource. This is a discipline that needs to be seen in the planning, the budgeting, the execution and implementation of projects. And so these 3 aspects also need to be underpinned by solid governance, transparency, accountancy, and accountability, rather, and ensure that the impact of debt will, in fact, lead to improved living conditions for populations. These are the important areas, to my mind, as we think about building back better and a recovery post-COVID-19. So these were some of the areas that I wanted to share.
We'd like to thank you for sharing with us all your expertise and so many pointers there. I just want to go back, Monsieur le Ministre, donc, sur cette question.
Mr. Minister, on innovation and the fact that digital is crucially important for Africa, what are your recommendations in order in terms
to stress on innovation, and digital is certainly going to help African countries to leapfrog in terms of development. We have the opportunity to really introduce digital, for instance, in domestic revenue mobilization. The tools are going to help us be more efficient, more, increase our tax base because of the possibility to reach not only those who are in the informal sector, but also those who are already in the formal sector. And this will also help us improve on the cooperation, collaboration worldwide. Why? Because with digitalization, we are capable of sharing information across the world, cooperate, and be able to fight against some of the weaknesses we have already identified in illicit flow of resources, fiscal evasion, and so on and so forth. I believe that beyond the instrument, legal, regulatory, the digital will help us be more efficient, reach out quicker, faster, and be more capable of mobilizing domestic revenue, which is important, above debt, which is certainly a critical issue.
Very much, Minister. Thank you to stressing that point that Africa has to build back. We have to leapfrog indeed into the next level of our development. And now, but not least, je me tourne vers vous, Madame.
I turn to you, Madam Minister of Planning and Development for Côte d'Ivoire, to hear your views on these questions. Madam Minister, please, and more specifically on the way forward in terms of debt management in Africa. How do you see the future, Madam? Thank you very much, and much like other speakers, I would like to greet and commend the chairperson of our Board of Governors, the Minister of Finance of Ghana, the President of the AfDB, as well as all governors. Thank you to our institution for providing us with this opportunity to discuss this highly timely issue. As has been said, Africa's debt is growing. It has grown twofold in the 10-year period between 2009 and 2019. And as was said earlier, it will further increase by 10 to 15% of GDP between 2019 and 2020 in the wake of COVID. So this is a substantial upward trend since servicing of this debt will reduce the government's and the country's abilities to provide basic services, health, and education to their populations. It is true that we periodically and have seen some measures to restructure debt, so somewhat sporadically and haphazardly, but this has not provided a sustainable resolution of this debt issue, and hence the relevance of our topic and the importance of reforms that must be undertaken, which do seem to be the right way to go. Previous speakers have announced their relevant approaches, most notably approaches that will increase domestic resources. It is important to mobilize these resources based on statistics that will enable us to identify all of our taxpayers. So many of our economies are faced with challenges because the tax bases are very small. In Côte d'Ivoire, for instance, there is a very large proportion of prominent economic players, but that remain in the informal sector. We must therefore identify and collect taxes from individuals as well as corporations. We must also leverage land and property and ensure that the tax burden is shared by all. We are in countries where the informal sector is quite prevalent, and one important aspect of this reform policies is this dimension of citizen discipline and ensuring that citizens pay their taxes and with the focus on use of debt and debt management. So all of these are ways to enhance our capacity to mobilize resources. The second aspect has to do with expenditure and expenditure efficiency. And as my brother Alamine said, that is to say, a fiscal discipline. We need to have an expenditure discipline that is transparency, that will ensure compliance with public management standards, and that which focus on transparency in public procurement especially. That's crucially important. In terms of markets, I think that if we want to be effective in debt management, it's crucially important to emphasize investments and to prioritize high social and economic value investments in when we allocate the resources available to us. Earlier, I talked about informing and outreach to citizens in public management. It's also this culture of accountability of public resource managers, so to have and instill this sense of accountability. We also talked about digitization, which is crucially important for effectiveness and transparency. I won't dwell much on this. However, I do believe that in terms of digitization, it's crucially important to link different systems from data collection and oversight, which will streamline public finance mechanisms and also facilitate tax collection. I'll close by highlighting the adoption of debt collection mechanisms in all of our countries. We have different mechanisms which we rely on, and these mechanisms could be greatly improved and could, if they are improved, assist countries in better managing their data management and also the information that's used for data management. So I'll stop at that. I think in terms of collection as well, there's room for improvement. But in terms of financing, I think we can talk about that later. And so to enable our continent to meet all of the challenges it faces. Thank you very much, Madam Minister. This is a fascinating discussion. Unfortunately, we are coming to the end of our time. Thank you once again for sharing your experiences with us. You have shared a tremendous amount of opportunity with us, as well as a number of recommendations that we could all gain from implementing and learning from. Thank you once again, Minister Shikuba. Minister Ousmane May from Cameroon, as well as the Madam Minister of Planning and Development of Côte d'Ivoire. Thank you to the Governor of the Central Bank of Egypt as well. Thank you and goodbye.
Excellencies, ministers, and dear friends, I would like to thank President Adesina for inviting me to take part in the discussions today. The African Development Bank's annual meetings are taking place at a critical moment for Africa and for the world. More than ever, we must all come together to end the pandemic and secure the recovery. Africa is now facing the world's fastest growth rate for new COVID cases, with an exponential trajectory even more alarming than during the second wave in January. We fear that based on current trends, this wave will likely surpass previous peaks within the next weeks. It is a human tragedy and an economic calamity. Countries across the continent, from South Africa to Uganda and Rwanda, are forced to reintroduce restrictions, further denting a precarious recovery. In the face of new variants, Africa is ill-protected due to severe vaccine shortages. So far, as you know very well, only 0.6% of Africa's adult population have been fully vaccinated. The warning signs are clear. A two-track pandemic is leading to a two-track recovery. Africa is already falling behind in terms of growth prospects. This year, we project the global economy to grow by 6%, but only half that, 3.2%, in Africa. This ought to change for the sake of Africa and for the benefit of the world. Africa can and must grow 8, 9, 10, 11, 12%, twice what the rest of the world, so it can catch up and fulfill the aspirations of its people. It can do that. It requires, of course, actions in Africa, but it also requires international cooperation on multiple fronts. First, step up international cooperation to end the pandemic. Our staff recently proposed a $50 billion plan that involves vaccinating at least 40% of the population of all countries by the end of this year and at least 60% by mid-2022. This $50 billion price tag is dwarfed by the estimated $9 trillion boost to global economic activity by 2025 from faster vaccine rollout and faster recovery. It would be the best public investment in our lifetimes, and it would be a game changer for Africa. Together with the World Bank, WHO, and WTO, we are forming a war room, a task force to monitor and accelerate the implementation of this plan. I am encouraged by pledges for vaccine support from international partners, including 1 billion doses announced at the G7 summit. I strongly support efforts to diversify vaccine production on the continent. And I commend the African Development Bank and the African Union for providing vital support, for providing leadership, including through rapid response facilities and vaccine procurement, and bringing Africa and the world together to act. At the IMF, we are also working on deploying our financing instruments to ensure that health systems have the capacity to save lives and secure the recovery. Second, help Africa deal with the growing mountain of debt. Debt levels, which were already elevated before the pandemic, have increased sharply, not surprisingly. Public debt in sub-Saharan Africa jumped by more than 6 percentage points to 58% of GDP in 2020, the highest level in almost 2 decades. Interest payments last year reached 20% of tax revenue for the region as a whole and exceeded 1/3 of revenues in some countries. Similarly, public debt in North Africa rose by about 12 percentage points to an average of 88% of GDP last year, with the same consequences. To help safeguard debt sustainability, the world has stepped up. The IMF has provided debt service relief to its poorest members, And together with the World Bank, we advocated for the G20 debt service suspension initiative, as well as for the common framework for debt resolution, designed to provide deeper debt relief to countries with higher debt vulnerabilities. Thanks to the joint efforts of our members, we have reached 2 historic milestones. Last year, Somalia received debt relief under the enhanced keeping decision point and is now benefiting from international financing, including from the IMF. And today, Sudan is on the same path. And I want to recognize all African governments that have stepped up in solidarity, both with Somalia and Sudan. The DSSI has produced much needed breathing space, and it has been extended until the end of this year. Now is the time to make the common framework fully operational. There are 3 countries that have asked for that treatment under the framework: Chad, Ethiopia, and Zambia. And I'm encouraged that Chad recently received financing assurances from its G20 bilateral creditors. In other words, we are on the right track. We now need speedy commitments on comparable terms, especially by private creditors. And we want to always make sure that other official bilateral creditors are in. Why is this so important? Because successful implementation of the common framework in the first cases under consideration is critical for other countries with unsustainable debt levels to step up, to seek early action for debt resolution. This is particularly important in light of strong growth in the developed world, especially in the United States, and the likelihood of gradual monetary policy normalization that could increase the cost of debt service over the next years. Third, the international community can help strengthen Africa's recovery and resilience. Well, clearly the best way to deal with debt, and many have spoken about it, is for economies to grow. This is not an easy task during the pandemic when governments face reduced revenues and increased spending on crisis measures. But this crisis is an opportunity for transformative reforms, to improve public finances, to strengthen governance, to deal with leakages from what tax authorities are to collect. Think of how digitalization can improve tax administration and revenue collection, and the quality of public spending. With radical transparency, Africa can tap into new sources of finance. Let me just frame one that is so important: carbon offsets. And there is room to encourage more private investment in social and physical infrastructure. As noted at the G7 summit, development financing institutions and multilateral partners intend to invest at least $80 billion into the private sector in Africa over the next 5 years. And the G20 Compact with Africa remains a key framework to enhance the business environment in Africa, make it more attractive. Now is the time to expand and strengthen this initiative. We also need to modernize international taxation. We see growing support for a global minimum corporate tax, which can end the race to the bottom and reduce tax avoidance. We welcome international efforts on digital taxation, very promising source of revenues if it is done right. It would help ensure a fairer distribution of tax revenues, and it will help address Africa's significant financing needs. At the IMF, we are doing our part. We swiftly ramped up our financing for the continent, including by providing in 1 year 13 times our average annual lending to sub-Saharan Africa. We have received support to increase access limits so we can scale up our zero interest lending capacity. And as we speak, Our executive board is discussing the successful completion of Egypt's standby arrangement, a great example where the IMF has provided significant support, $8 billion, to help Egypt address its pandemic-related financing needs and safeguard that sustainability. Our membership also backs an unprecedented new allocation of special drawing rights, $650 billion, by far the largest in our history. Once approved, which we intend to achieve by the end of August, it will directly and immediately make about $33 billion available to our African members. It will boost their reserves and liquidity without adding to their debt burden. And it will help address their emergency needs, including for vaccines. In addition, we are working towards a very important innovation to magnify the impact of the new allocation by encouraging voluntary channeling of some of the SDRs of our strong position members, or adding budget loans to reach a total global ambition of $100 billion to be transferred to the poorest and most vulnerable countries on highly concessional terms. We are exploring with our membership options on how we can get this done through the Poverty Reduction and Growth Trust and possibly a new Sustainability and Resilience Trust. And I look forward to input from our African members on what best would serve your aspirations, your needs. So let me conclude. It is a pivotal moment. And in this moment in history, Africa can count on the IMF. We are deeply committed to all countries in the region, supporting the heavy lifting on recovery efforts and transformative reforms. Together, we can move mountains. Together, we can lay the groundwork for a more prosperous and peaceful future. Thank you very much.
Thank you ever so much for your contribution today. And now I would like to leave the floor to Kenneth Atta Ofori, Chairperson of the AU Commission.
Thank you, Kristalina. This is just an excellent way to begin the process, because I was quite worried about how we were going to tackle the international platform. I think the reality for all of us is that we are working on a platform that was established in 1948, the Bretton Woods, 77 years old, and we have had various experiences such as this pandemic, which has really showed the underbelly of that system and whether it is relevant for a continent that is going to be a quarter of the world's population and maybe half of the youth of about 850 million people. And I think that deserves a certain amount of urgency to be able to fundamentally ask the questions whether the current system is really fit for purpose and for the future prosperity, not only of Africa, but of the world. Because you may look at an innocuous covenant in fund managers' agreements, which does not allow a certain investment, which does not allow certain investment beyond certain grades that our revered rating agencies have given. And so a whole slew of trillions of dollars are cut out from coming from the continent. However, you go back to examine maybe the returns from these pension funds, and you realize that trillions of dollars are underperforming or at zero or at very low yields. The question then is, what is it that we can create to give that comfort to all of these pension fund trillions of dollars that are suboptimal, and you leave Africa out of being able to play with this money. And I think we really need to sit, as a global effort to re-examine those fundamentals, which I believe in 48 was about the investment gap and the needs of investment and how best to bring back Europe and the Western world. And the question now is, can we sit down to re-examine these basic rules and know that, there's a better way of really deploying these assets for greater prosperity without any increased risk to the Western world. I think the issue also of the current discussion about changing the corporate tax is also indicative of the slowness in which the West reacts until it is bitten itself, because the issue of this illicit financial flows has been on the table forever, and there has been no reaction until it really was affecting the West. We look at the current situation with the pandemic and busing nationalism, and it's now quite embarrassing to see what the proportions are and then our reaction to it. So I think there needs to be, a sense of urgency about truly what our common humanity entails. And we really need to form a high-powered group of people to think through the structure so that these events will not have such a cataclysmic effect on Africa. Thank you very much.
Thank you very, very much, Mr. Ofori-Atta, Chairperson of the African Union Commission. And I am absolutely delighted now to introduce my co-host for the day, Femi Oke, who will chair our next panel. Femi, the floor is all yours.
Welcome to the second panel of today's knowledge event. I'm Femi Oke. There is a radio show that I listened to for many years. It's called World Have Your Say. And people from around the world, they pile in, they weigh in with their thoughts and their ideas and their solutions to important world events. I am thinking of this panel as governors have your say, but we are setting the bar way higher than World Have Your Say. The reason we are doing that is because this is a knowledge event. So our governors are going to be coming with knowledge, sharing their knowledge, and also solutions. Our focus for the next 20 minutes is international cooperation and coordination to help mitigate debt vulnerability across the African continent. I really want you to meet your panelists. Let us start. We're going to do this in alphabetical order, in case you were wondering. And we go first to, and I will get all of the panelists to unmute themselves, be ready, be standing by to do a one-sentence introduction. So let me greet all of them as they join us. Ms. Zainab Shamsuna Ahmed from Nigeria.
Hi.
Welcome. Please introduce yourself. Good to see you.
Good day. My name is Zainab Shamsuna Ahmed, Minister of Finance, Budget and National Planning, Nigeria, and I'm happy to be in the panel today. Thanks, Fanny.
Delighted to have you. Mr. Christian Asinelli from Argentina, welcome. Please introduce yourself.
Good morning. I'm very happy to be here. I'm Christian Asinelli, Undersecretary for International Affairs of Argentina, and actually candidate for the President of CAF, Development Bank of Latin America. I'm very happy to be here with my friend, President Adesina, and my colleagues.
Good to have you. Mr. Atsushi Mimura, so nice to see you. Please introduce yourself.
Hello, everybody. My name is Atsushi Mimura. I'm a Japanese deputy to AfDB and other MDBs, including the World Bank. And I'm also in charge of the development finance policy of the Japanese Minister of Finance, including debt issues such as Paris Club and DSSI or Common Framework. I'm happy to join this meeting. Thank you.
Very happy to have your expertise in our conversation. Mr. William Roos, nice to see you. Please introduce yourself.
Merci beaucoup, c'est un plaisir d'être avec vous. Je suis le gouverneur suppléant.
Thank you very much. I am very pleased to be here with you. I am the alternate governor for France for the African Development Bank. I'm also the co-chair of the Paris Club. Thank you.
Thank you. And Ms. Yasmin Wahabrebi Said, welcome. Please introduce yourself.
Greetings, all of you. I'm Yasmin Wahabrebi, the State Minister of Finance of Ethiopia. I'm responsible for the external economic cooperation of the country. I'm also the alternate governor of the African Development Bank and happy to be joining this knowledge event, which is addressing a very critical topic. Thank you.
So much expertise right in front of us, annual meeting. So let's start here. Let's talk about promoting realistic lending and borrowing ideas by the international community. How do you do that so that both the lenders and the borrowers are taking responsibility? Let me start with Mr. Mamura. Thoughts?
Yes, thank you very much, Femi. My answer is very simple. Transparency. As was already mentioned by President Adesina at the beginning, we really need transparency because how much money you borrow from whom, according to what terms. Unless you have this basic information, you can never conduct public debt management or public finance management. So we really need this transparency. And long experience tell us that not only borrowers cannot be done by themselves only this, because sometimes, data between borrowers and creditors are not exactly matched with each other for whatever reason. Sometimes the data is outdated, or sometimes capacity reason, or sometimes there may be some misunderstandings among two counterparties. But for whatever reason, in order to have a timely and accurate information about how much you owe from whom, according to what terms, you need to reconcile data both from borrowers and creditor side. And that's why Japan is calling for the importance of debt data reconciliation, which is proposed by the World Bank and IMF. So I think this transparency is really the key for responsible lending. Thank you.
Mr. Mamori, you're amongst friends here, so I'm really curious. Who needs more transparency, the lenders or the borrowers, where we are right now today?
I would say both. First of all, unless we know from our lender side, unless we know how much money borrowers are borrowing from whom, according to what terms, we can never know whether we are lending too much to those borrowers. But of course, on the borrower side, unless you know how much money you have, it is already going beyond the limit or not, you can never know without having good transparency. So really, this transparency is key for both lenders and borrowers. But especially for borrowers, it is really important. And I think this is important not only for the African government, but also for the people of Africa. Thank you.
Wow, that's so simple, but yet so difficult. Mr. Roos, I want to bring you into this conversation. We were talking about promoting realistic ideas for both borrowers and lenders. Realistic is the key, right? Or should we be super ambitious? Mr. Roos, what do you want to add?
Vous avez raison. Il faut des solutions.
You are indeed right. We need realistic and ambitious solutions. Ever since the onset of the crisis, one of the novelties is to try to address debt vulnerabilities at a multilateral level, because debt, is sometimes hidden, sometimes not very transparent. And in this respect, I do agree with my colleague from Japan. Now, what we were able to secure at a multilateral level, that is the G20 level, is to come up with something which can actually work. The common framework which seeks to address any debt issues which country may encounter. Now, why is this innovative? It is innovative because we coordinate not only amongst countries which are already in the habit of coordinating, especially the Paris Club, but we also embrace other countries which would be cooperating with the Paris Club for the first time. I'm thinking of Saudi Arabia, India, and China. All of us seated at the same table to seek a solution to Chad's woes. And personally, for quite a few months and weeks now, I have been working on this. So we coordinate and also synchronize our actions with the IMF and the World Bank in such a way that our debt treatment initiatives allow for financing from the IMF, support from the World Bank, and that this is also well coordinated with the reforms along the lines as what has been said already. Third part, in a world where the debt architecture has changed with an increasing presence of the private sector, we are also looking at comparability of treatment between official lenders and private lenders. So this solution, this common framework is very new. It is a bit slow, probably overly so. I do understand some criticisms, but it has to work. I mean, there is no other way out. As the managing director for the IMF said, we have done something for Chad, and once the private lenders would have given their agreement, Chad will be enabled access to IMF financing. I am working hammer and tongs for us to come up with such a committee for Ethiopia. We cannot really wait for such a solution. We need to think about starting the discussion and to conclude this innovative solution, this common framework should not be considered as a stigma, but rather as a solution. And we are convinced that for the countries whose sustainability issues we will be focusing on, we have countries with liquidity issues which do not necessarily require a downgrade from the rating agencies.
So much. All right, let me just bring in Ms. Ahmed, because what is a realistic idea from a lender is not necessarily a realistic idea from the borrower's perspective. Ms. Ahmed, from what you've heard so far, what would you say is encouraging? Please go ahead.
Well, thank you very much, Femi. Well, it is encouraging to me in the first place that we're all talking about this issue which is facing us in the face. This COVID-19 only compounded the very fragile economies that we have. So there is a problem of debt within the African continent, and I'm glad we're discussing it. What is unique for me is that part of the approvals that Ahmed just got is this increase of the 650 billion SGRs, and that part of it could be not only on lend to our countries, so there's a possibility to set up this liquidity financing facility that would help our countries to borrow at lower cost, but also it will help to bring in crowd in the private sector borrowers. And this discussion of having to prioritize, reprofile our debts and also restructure our debts. All of this have been happening with just the multilateral institutions, the private creditors that we owe a significant amount of funds to are not in this discussion. And so there's a very significant gap. This is also an opportunity for us for a call to collective action to include things like acceleration clauses in our credit that we write, to also use state contingent debt instruments to help us to boost our management of public financial management debt. In Nigeria, we'll be making a lot of effort to, on a quarterly basis, disclose all the debts that we are borrowing and also to indicate what the debt service is. And currently, we're working to include other state-owned debts that are not in the public debt for the purpose of transparency. We think that is important and is going to help us going forward.
Ms. Ahmed, you don't have to answer this question, but I would be delighted if you do. What is the sovereign debt of Nigeria, the public debt?
So
it's in the billions, correct?
Yes, we are at first quarter of 2021, $35 billion US. And that's about 29% debt to GDP. So in terms of the level of debt, is still very healthy, very much sustainable.
I'm glad you're saying that because I'm having a heart attack, but Ms. Mamora is just like, that sounds reasonable. Okay, go ahead.
But we are struggling with revenues, which is what you need to pay the debts. So we have put in place a number of measures to enhance our domestic revenue mobilization. We're cutting costs. We're improving the ease of doing business, trying to leverage on private sector resource capacity to invest in infrastructure to reduce government spending. We're working on increased transparency in public financial management. We're enforcing fiscal discipline to expand our fiscal space so that we can continue to service our debt and borrow more to bridge our infrastructure gap.
All right, thank you so much. I can see Mr. Asinelli is doing this. He's thinking deep thoughts. I cannot allow them to stay in his head. Mr. Asinelli, go ahead, weigh in.
Thank you, Ms. Feni. I would like to say, as my president, Alberto Fernandez, always says in his speech and in every international forum, that the world needs a development, a fair global system. A very similar speech said another Argentine, the Pope Francis, when he urged global leaders to change the international system rules to reduce the gap between rich and poor countries. And in this sense, Pope Francis always speaks about economic fairness. Principle of fairness impel us to develop a global system in which distributed justice plays its part among medium and low-income countries. This is very important for us. Since Bretton Woods, as previous people said here, the world has shared growth, but the inequality among countries has increased, and the pandemic has aggravated in this sense. When in a debt crisis, it takes much time for countries to start to undertake the problem. When they start doing so, most time they don't receive enough relief to reestablish the necessary conditions to regain growth. We can learn from Argentina's painful experience with historic debt restriction. Ms. Kristina Georgieva now is helping a lot our country. And fortunately, the whole world has learned many lessons from Argentina. First, in 2014, from our hard experience with holdouts and judge intervention, who do not understand the goal and the characteristic of sovereign debt restructuring. Thankfully, in Argentina, more recent debt renegotiation process with the private sector, we have had support from G20, the private international sector, and the international academic sector also to our proposal of restoration of long-term sustainability. I think that Argentina has effectively maintained a constructive dialogue with the IMF since the beginning of the public debt sustainability restoration process in December 19. In fact, the sustainability framework of the Argentina public debt developed by our government is working in the same way with the IMF.
Yeah. Thank you so much. Ms. Sayed, your portfolio is international economic cooperation. So when we're talking about what can the international community do, I know you've already got a checklist, right? You've already got thoughts about what kind of cooperation support you need from the international community to particularly help with Ethiopia. And I'm sure that model will work for other countries across the continent. Please go ahead. Love to hear from you.
First of all, having a sovereign lending and borrowing which is prudent and disciplined is very crucial for African countries' sustainable economic growth. Otherwise, it would be very hard to really make our debt sustainable and prudent. And in another word, for instance, when we look into Ethiopian core issue, which is at a macro level, is high debt stress of in the economy, which the reform is trying also to address. Most importantly, from the international community perspective, we have been engaging to get more debt reprofiling, while we are very prudent in terms of not overburdening our debt stock, especially on the commercial side. So, so far the progress is good. We have gotten some rescheduling of our debt from our bilateral creditors, but the COVID pandemic came in and really doubled and tripled our debt stock to be reprofiled because of the growth projection was affected by the pandemic. So we have welcomed the DSSI initiative that was launched by the G20 countries, but that was not sufficient enough for a reason that we wanted to bring our high debt risk level to moderate level in the 3 years reform period. So we have been engaging with our bilateral creditors, and then of course the G20 also noted the global situation and how this DSSI initiative wouldn't help much. So now we are in the common framework that the IMF is also supporting, which was also indicated by many of our speakers that Ethiopia has submitted together with other countries as well, like Chad and Chad. But the process so far is very slow, and it's also costing us a lot. For us, we want to really bring our debt to moderate level, and so that we can get more financial access in terms of financing our big investments, and also to correct the imbalance in the macro side. But at the same time, joining the common framework is really costing us, because from the private creditors aspect, they are very worried what would this entail, because in the common framework they are expected to provide comparative treatment, and still the progress is not fast enough. And in our credit rating by the 3 rating agencies, we are facing downgrades, and also we are put on further downgrades. So this is a key area which I would like to call the international community to support us, because at the end of the day, it's mutual partnerships and collaboration. It cannot be one-side effort only. It's not only also for Africa, but addressing this issue goes beyond, and making sure Africa, which is the biggest economy, functions properly, and also in terms of further investments and from our bilateral cooperation is very, very key. That's one of the big asks I would like to make, and I'm sure the Paris Club is also pushing the process, because they are the lead in this. But our bilateral creditors has to come on board, and we push this common framework move forward. Thank you.
Thank you. I am going to ask you, panel, to do one last thing. It is extremely challenging, because I'm going to ask you for one word. So our panel session was about international cooperation and collaboration for mitigating the debt vulnerabilities in Africa. We're looking at the road ahead for Africa. What one word is appropriate to describe that road ahead for Africa? One word. Is it bumpy? Is it smooth? Is it fast? What is that one word you would use? Ms. Sayed, your one word for the road ahead for Africa is what?
Prosperity.
I have driven down that road for sure. Thank you so much. Mr. Asinelli, how is the road ahead for Africa in one word?
For me, the word is social justice.
Oh, I have not been down a social justice road, but I'm looking forward to finding that route. Okay, Ms. Ahmed, your road ahead for Africa. Your one word, what is it?
Positive impacts for people.
Very nice. I love that road. I'm going to find that road for sure. Mr. Roos, the road ahead for Africa in a single word is what?
Je répondrai appropriation, ownership. I would
say ownership, African ownership.
Yeah, fantastic. We're not leasing that road anymore. We're owning it. Mr. Memora, the road ahead for Africa in a single word is what?
I would say solidarity. Solidarity within African society, and also solidarity between lenders and creditors. rented creditors and borrowers. Thank you.
Wonderful. So many beautiful roads ahead for Africa. Panel, thank you. I enjoyed my time speaking to you. This truly was a knowledge event and you set the bar very, very high. I am going to hand back to Dr. Adesina, President of the African Bank, for his final thoughts and takeaways. Dr. Adesina, over to you.
Thank you very much, Femi. Well, let me thank you for making the road to be here and to help us in moderating what has been a really exciting session. I'd like to thank my dear sister again, Kristalina, for being with us, and thank you for your excellent comments, and thank you to my sister Ngozi, and also, of course, to thank you, our governors. That was a really rich and exciting conversation. With lots of takeaways. Let me try and see if I could summarize some of the key things. First is that we must get shots in the hands of people. You know, without vaccines, the economies will not recover, and obviously they won't earn revenue. And of course, we're going to continue to have problems of debt because they cannot pay back the debt. So vaccines, critical to get that done. The other thing is that let us also differentiate. The situation of low-income countries is very different also from middle-income countries. A lot of the efforts that are being made today, it's for low-income countries, which is needed, of course, and it should be. But let's not forget that we have also vulnerable middle-income countries that we should look at. The SDRs, you know, I'm going to find, you know, I have 3 grandkids now, and maybe I'll talk to one of my my kids to have another child, and I'm going to name that child SDRs for Africa. We actually absolutely need more SDRs. For Africa, and I think it was great to hear from Kristalina and for all the great works that you are all doing, and we need more resources, as you heard from President Nana Akufo-Addo and all of our governors there. But the critical role also for African institutions to, as we look at international financial architecture, the very strong role, as you know, that African Development Bank needs to play, and also other African institutions, as we look at that, becomes very critical in the road ahead. But we must also make sure we don't lose time. We just heard from the minister from Ethiopia, time is of the essence. We must be quick, we must be responsive, we must be flexible, but we must be solutions driven. Africa cannot accept nor afford to have another lost decade. Now, whole issue of transparency, that becomes very, very critical. Transparency in terms of debt, transparency in public financial management, transparency in revenue collection, and also in the management of the revenue themselves. We heard quite a lot from the governors about the importance of domestic resource mobilization. We need to take advantage of sovereign wealth funds, pension funds. I always say, you know, for pension funds, you know, pension funds of Africa are always invested outside of Africa in money market instruments that are earning negative real rate of return. Well, you know, if pension funds are supposed to pay you annuities for the rest of your life, but if you're going to use pension to get your annuity, but you're living in an environment without water, without education, without sanitation, without hospital, of what use are the pension funds? So Africa cannot have a situation where those pension funds are being used outside of Africa without investing in infrastructure. Now, a lot of what we've talked about today, it's all around debt, yes. But let's not forget that a lot of the debt in Africa, it's actually for infrastructure. The minister, Zainab from Nigeria, was talking about that a moment ago. One of the things that I feel we need to do is to mobilize pension funds and sovereign wealth funds to have asset classes devoted to investment in infrastructure, quality infrastructure. That is fundamental for us. The other thing, of course, is to realize that the governments themselves don't have to take all the weight. Infrastructure doesn't have to be done only by governments. Private sector can do infrastructure, and I think this needs to be very, very important for us to be able to manage a lot of the debt, because most of the debt is actually infrastructure related debt. We heard a lot about digitalization. You know, if you can get money in, if you have money, then you can pay. The importance of digitalization, I think that is going to be very, very important for us for financial inclusion, but also for revenue generation, for tax administration, and for also transparency. I was delighted to hear about the point on the issue of international taxation. We'll be following that very, very closely. because Africa, as you know, loses at least maybe $60 to $80 billion in terms of illicit capital flows. And we need to block that, and why go borrow money outside when you can actually fix problems at home and do the right things by everybody and by the multilateral, not multilateral, by the international agencies, the corporations. So let's work, earn money, but let's earn clean money, and let's not shortchange Africa. That's very, very important. I think that we had a lot about the importance of preparing, anticipating for what will come. We had Ebola, we had SARS, now we had COVID-19. Well, something is going to happen somehow along, at another point. The issue of debt prevention and preparedness is fundamental, and make sure that we can prepare for external shocks like that. And that, again, reinforces the point on having the Africa Financial Stability Mechanism, as we have discussed in the earlier part of our session. The issue of transparency, debt transparency, I would say 3 times: debt transparency, and debt transparency. We actually need to have better data, regular data analysis, putting in place creation of medium-term debt strategies and publication. We were hearing it again from my sister Zainab in Nigeria about annual debt reports. These are very, very important to know. And we should not have anything under the table. Everything should be on the table. We must know exactly all of what we are dealing with. The importance of independence. We heard it from the minister from Egypt. The independence of the monetary policy, and also on the fiscal side to be able to manage economies well. That's very important. I'd like to add to that the importance of natural resource governance in Africa. Africa is not poor. It's just not managing its natural resources well. So we got to make sure that we have transparent, accountable governance over all of Africa's natural resources so that we can be used well for the development of our continent and, of course, our people. We heard about structural reforms that we need to do to drive growth. In terms of that, at the end of the day, what are we doing? Debt is to impact people. So there must be accountability for how it is providing energy, that it's providing food, it's in providing water, sanitation. It must translate to things. People can't just simply take that and not see what it is meaning in their lives. And let me also say that we heard quite a lot about the issue of building institutional capacity, because these are heavy lifting issues in terms of quality of our institutions, their debt management capacities, their ability to carry debt. We heard it from Dr. Okonjo-Iweala. And finally, the importance of private sector. Private sector, if they are not part of it, especially given the fact that a lot of the debt, 40% of it, is now in the hand of private creditors, we're not going to have a solution. So I think I'll come back and close with what the minister from Ethiopia said. She said the process is too slow. It's costing out a lot. And, the jury is still out on that. We are all supporting, but we've got to move faster because, we are just basically no time. So thank you all very much, dear governors, for excellent inputs. Thank you very much to you for Femi. Okay, thank you, Anne-Marie. Thank you, Kristalina. Thank you, Ngozi, Okonjo-Iweala. And my last word, Femi, mine will be resilience. Resilience. Yeah. All right. Thank you very much.
Thank you.
Thank you. All right.